At last year's conference, we had the opportunity to hear from one of our attendees about how he thinks about his own personal portfolio construction. Tom Darden's here with us again today, and he's going to have an opportunity to share how he thinks about constructing his own portfolio, how he's made personal private equity investments over the last 20 plus years. Tom, it's great to have you with us. Would you mind sharing a little bit about how you think about making investments from your own portfolio?
Hey Luke, it's nice to be with you. I first had some capital to invest when I was around 30 and I'd sold a business. And I was deeply influenced by the teaching of Howard Dayton and Larry Burkett, Crown Financial Ministries, about your money having spiritual significance, or that your management of your own resources being an element of your spirituality. I think most people would think, and probably prior to that point, I thought also that was separate somehow from the rest of my life. And so if I had any resources, which I didn't at that time, fortunately, it would have been an acceptable thing to hand them off to someone else to manage however they wanted to, and then I would go and live my life. But I came to believe that how I managed my resources was a part of my spirituality, and that led to a belief that I could use my resources to have a positive impact on people's lives and on some problems that I saw as being very significant, and I felt like I could make a difference with. Having that thought, I then figured, well, the best way to do that is to make direct investments into businesses as opposed to investing in public markets. And the reason for that was that the relative impact, the impact I can have on a public company is approximately zero, whereas the impact I can have on a private company, particularly one that I started myself, could be very high. And I made kind of a vow, a personal commitment, that that's all that I would do. And since then, I've largely been consistent with that vow. That is, that I would not invest in public securities, mutual funds, bonds, stocks, anything really that was publicly traded. Not that I have something against public markets, but it's sort of, as a category, an area where I can't have much impact. And conversely, that I would invest in private transactions with people that I know and regarding problems or technologies or businesses that I have something I can add some value to. That's led to investing in around 200 separate private transactions since I started all this, which was around 1984, 85. And the portfolio, currently in that portfolio, or about 40 deals remain in that portfolio at this point. So of the 200, I guess 160 have either sold or liquidated in some sense. Around 25% of the 200 companies I started or I co-founded. That is, I had the idea, or someone I knew had the idea, and we came together and built a business around that idea. The results have been okay. It's too early to tell. I've been doing it for 30 years, but it's too early to tell because there are 40 deals that are outstanding at this point out of a couple of hundred. But if I look at realized transactions, it looks like it's probably been about a 16% return over that time period, with very favorable tax treatment because all the gains, to the extent there are gains, tend to be capital gains. I do have more variability than most people do. Roughly 50% of my deals have lost money, not necessarily all the money, but some of the money. And I've not had any huge winners. It's been there might have been 10 or 15 deals that were responsible for 80% of the returns, but there hasn't been some whale of a deal in there. So that's been another element of the strategy has been to be fully invested at all times. I feel like there's an element of your responsibility associated with having a bunch of liquidity. What's the purpose of liquidity? Unless you want to spend the money, and if you have a bunch of liquidity, maybe you're going to spend the money, which is probably not a good thing to do. I feel like being illiquid has kind of protected me from spending more money, and so my goal has been to be fully invested, as fully invested as I possibly can at all times, and it would be astonishing if I were less than 90% invested in these illiquid private transactions at any one time.
That's a super interesting approach, Tom. How do you think about debt versus equity? And have you ever had a company go public? How do you behave in that context?
Regarding debt, I don't intentionally invest in debt. I don't invest with a goal of making a loan, but often for structural purposes, debt is convenient, particularly if it's a transaction, if it's a company that I created. I will lend money into that structure, and it has more favorable tax treatments if you don't go forward in particular. Well, even if you do go forward, because the initial return would be just return of capital. So there are reasons why debt is beneficial. Obviously, in the venture world now, a lot of people prefer a convertible debt structure, and that's okay too. I've participated in a number of those also, but I really don't. I really haven't been involved in investments where my intent was to be a lender in the transaction. And regarding if a company goes public, that's probably happened 10 to 20 times out of 200 deals. So not a lot of deals. And in every instance, I ended up securities in the other company. And typically, I sort of threw them in a drawer, so to speak, and didn't do much with them, and just held on to it. So that has been the one category of public stock that I have owned, has been stock I've gotten from a company in an IPO. And over the years, typically I would donate it away because of the ease of doing that with a donor advised fund. I use NCF, and you donate the appreciated securities. It has favorable tax treatment. So for the most part, I'll use that for charitable donations when I get public securities.
So Tom, how do you think about liquidity? One of the things that must be true about building your own private equity portfolio of predominantly illiquid investments is that you must go through periods where you just don't have a lot of free cash to be able to invest in great opportunities that come across. And conversely, you may also go through periods where you got a lot of cash. How do you think about managing that within your portfolio?
Regarding liquidity, I'd say it works out pretty well on the one hand. On the other hand, I am very illiquid, and so you just have to be content living in a world without much liquidity. In a financial world without much liquidity, that is, you can't operate this way if you're carrying a lot of debt, clearly, or if you have a lot of high fixed expenses. But that's really part of the benefit of this, is that it discourages that psychologically. If you you don't have a lot of liquidity, then you tend to not pile up likely future needs of that liquidity. Regarding missing deals, it's interesting. I'm sure that I've missed deals that would have been great to be in, and I do find that very often I would rather have more capital to deploy in the deals that I do, on the one hand. On the other hand, I don't have a list of deals from the past that I look back on and say, wow, I really wish I could have been in that deal, or unfortunately I missed that deal because I just didn't have any capital at that point. I'm sure those deals exist, but the fact that they don't come immediately to mind makes me think that there must not have been a whole lot of them. There are a couple other principles that are associated with this, though, that I wanted to mention. And one is I have this strong preference for being fully deployed because that's a sense of responsibility. So aside from capital that I have good reason to believe I'm going to need for follow-on deals, I want to be fully deployed at all times. So that principle is stronger in my mind than the principle of having some capital available in case a good one comes along. And then the second principle, and this is parenting my buddy Jess Carell, deals are like buses. Another one comes along every 15 minutes. So if you miss something now or you don't have liquidity now, I'm not at all worried about not being able to find some other transaction at some point in the future. They're always coming along.